Every major investor in the room is positioned on AI, and almost none of them have seriously priced the one constraint that could stall the entire trade. This year, a chief executive of a major U.S. utility went on record warning that America faces blackouts due to a power supply shortfall. Not a decade from now. Soon. Here is the uncomfortable question that framing raises. If the power grid cannot keep up with the AI buildout that every chip stock, every data center REIT, and every hyperscaler valuation is already pricing in, what exactly are those valuations built on? When a utility executive warns publicly about blackouts, the instinct for most investors is to file that under infrastructure politics, a problem for regulators, not portfolios. That instinct is wrong, and here is why it is specifically wrong in 2026. U.S. electricity demand had been essentially flat for roughly 2 decades. Conservation gains from LED lighting, more efficient appliances, and industrial offshoring kept consumption stable even as the economy grew. Grid operators built their capacity planning around that flatness. Then generative AI arrived at scale, and the demand curve broke upward in a way that grid planners were not modeling. A single large-scale AI training cluster, the kind that hyperscalers like Microsoft, Google, and Amazon are deploying today, can consume between 50 and 150 megawatts continuously. To put that in context, 100 megawatts powers roughly 80,000 average American homes. These are not small draws on the grid. They are industrial-scale loads being added in geographically concentrated areas, often faster than new generation capacity can be permitted, built, and connected. The North American Electric Reliability Corporation, NERC, the organization that actually stress tests the grid, flagged in its most recent long-term reliability assessment that large portions of the country face elevated or high risk of energy shortfalls under peak conditions over the next decade. That is the regulatory body responsible for keeping the lights on, telling you the math is tight. The market signal embedded in all of this is not that AI fails. It is that the energy infrastructure layer of the AI trade is severely underweighted in most portfolios relative to the semiconductor layer. Everyone owns NVIDIA exposure. Far fewer own the transmission infrastructure, the independent power producers, or the natural gas peaker plants that are going to run hot for the next several years, while renewables and nuclear scale up. Let's be precise about the numbers, because precision is what separates a useful thesis from a vague macro narrative. Goldman Sachs estimated in their 2024 infrastructure research that data center power demand in the United States will grow approximately 160% by 2030. Other analysts using more aggressive AI adoption curves put that figure higher. Even the conservative estimate means U.S. data centers go from consuming roughly 17 gigawatts of capacity today to somewhere around 35 to 45 gigawatts within 4 years. For reference, the entire installed nuclear fleet in the United States generates approximately 100 gigawatts. You're talking about adding the equivalent of a third of U.S. nuclear output and data center demand alone in less time than it takes to build a single new nuclear plant. And this is where oil prices re-enter the conversation. Oil returning to pre-war levels in 2026 has created a counterintuitive dynamic. Cheaper oil compresses margins for energy producers. Yes, but it also suppresses the political and economic urgency around energy transition spending in ways that keep natural gas firmly in the bridge fuel position for longer than clean energy advocates want to admit. Natural gas generation is the realistic dispatchable backstop for AI data center loads for this decade. That is not an ideological statement. It is a grid operations reality. This creates a specific, investable angle. And this is not financial advice. Do your own diligence. But the companies positioned at the intersection of reliable, dispatchable power generation and transmission infrastructure build-out are structurally advantaged by a constraint that is only getting tighter. Independent power producers with contracted capacity adjacent to major data center corridors in Virginia, Texas, and the Pacific Northwest are worth understanding in detail. So are the companies manufacturing high-voltage transformers, where lead times have stretched to 2 and 3 years, because the grid cannot physically move power fast enough even when generation exists. Here is the part of this analysis that most chip-focused investors have not fully integrated. The semiconductor trade and the energy trade are not separate bets. They are the same bet. And right now, the market is pricing the semiconductor side of that bet as if the energy constraint does not exist. Micron is an instructive case. The memory and storage demand tied to AI inference workloads is real and structural. High bandwidth memory, NAND storage for model weights, DRAM for real-time inference. Micron's positioning in that stack is legitimate. But Micron's customers, the hyperscalers and cloud providers, cannot deploy more inference capacity than they can power. If data center expansion slows, because interconnection queues at utilities stretch to 5 and 6 years, as they are in some of the most power-constrained markets right now, that is a ceiling on Micron's total addressable market growth that does not show up in a standard DCF model built on AI adoption curves alone. The broader chip complex faces the same dynamic. The market has priced in aggressive compute expansion. It is not adequately priced in the possibility that power availability, not chip availability, becomes the binding constraint on that expansion timeline. This matters because it introduces a risk factor that is entirely outside the semiconductor company's control. They can fab chips. They cannot build transmission lines. The investment framework that emerges from this analysis is layered. First, energy infrastructure, transmission, generation, and the equipment manufacturers serving both deserves more weight in an AI-era portfolio than the current market consensus implies. Second, chip and semiconductor positions should be held with an explicit awareness of the energy dependency embedded in their growth assumptions. Third, and most importantly, the unsexy part of any technology wave is usually where the durable, less competed for returns, live. The grid is about as unsexy as it gets. That is frequently where the alpha is. We opened with a question. What are AI valuations built on if the grid cannot support the build-out? The answer is they are built on an assumption that the unsexy infrastructure layer solves itself quietly in the background. It will not. The constraint is real, the timeline is tight, and the market has not fully repriced it yet. Next video. We look at exactly which infrastructure categories have the most asymmetric upside given this energy bottleneck, and which ones are already overcrowded. Subscribe so you catch that one when it drops.